Hello, folks, and welcome to this year's first presentation. And I'll use this opportunity to say Happy New Year to everyone watching, and a Merry Christmas in arrears. So, this is trading the weekly range. Of course, my secret to short term trading. Okay. Trading in the weekly range in Forex. Before we delve into the nitty-gritty portion of this presentation, I think it makes sense to introduce this model, because this is a trading model, and this is what a trading model looks like anyways. And first off, we'll discuss the architecture of the weekly range. Now, what does the architecture of the weekly range, what does it mean? Well, it defines portions on the weekly candle, okay, and just identifying all of those key portions and how they translate into the whole idea of this model. Okay, first off is the open. I think everyone knows now that in Forex the market opens on Sundays, right? And it's significant in trading the weekly range, of course. For a technical perspective, nobody can predict the opening price, because we live in a society where tensions or geopolitical events could happen all through the weekend, and you can't really determine how the markets will open. Okay, so I don't think there's anybody that can determine if the markets will open. That's why when I was teaching, or when I was uploading my videos or my commentaries, I always wait for the markets to open first before I can speak on bias and stuff. It's not like I never had any bias prior to the market open, but sometimes I just need the market open to validate my bias. Okay, so we have the high, and in this case this will be the opening price of this candle. This is a line chart. Okay, line chart is not like the Japanese candlestick. Okay, this is a line chart. Let me include. Alright, so this is line chart, and this talks about the opening price, and this references the high of the candle, the low of the candle, and of course this is the closing price of the candle. Now, as we develop in this lesson, we can determine how all of these three factors, okay, or these four factors, influence our decision in trading the weekly range. I would try to contain my thoughts, because I have currently have lots of overflowing information I would like to share immediately, but I think if I share them now, it's going to mess up the lesson. So I want to take it slowly, and as we progress, I begin to speak more and more. Now, since we're already familiar with the architecture of the weekly range, the open, high, low, and close, and this lesson obviously is going to amplify on all of those four components, and how, like I said before, how they influence the weekly range, or how they help you interpret the weekly range. Now, but then that's one thing. The other thing then is to introduce you to weekly profiles. Okay, and in my opinion, there are about 3 weekly profiles, but for the sake of the integrity of this presentation, we are only going to treat one profile, because this model, the probability of this model increases with just this particular profile, and this is ideal short-term trading condition. So the first one is the trending weekly profile, or one-sided delivery. I mean, if you do not know what a trend may look like, I think you can pull up your chart to dollar index or Euro USD. I prefer dollar index, and pull up your chart to on the monthly time frame, and look at how the market has delivered for the past 3 months consecutively. Okay, now in the past 3 months, if you do not know, we've been one-sided on dollar index, meaning the market open, sets the low a bit, that means makes a short displacement lower against the high time frame buys and expand, then it closes. On the next month, what it does is it opens, sets the low quickly, and expand to the next area, and that's what a one-sided delivery looks like. Now, if we can take the knowledge of that and we transpose it to the weekly range, what does it mean? It means when the weekly candle opens, it sets the low quickly and expands. All right. Now you can see emphasis is it sets the low quickly, and that brings us to, time of day, day of the week, but more reference to the day of the week because we are trading in quotes again the weekly range, and if we're trading the weekly range, the element of time that is most important to us is not time of day, it's day of week. Reason being that, okay, generally between Monday and Tuesday, or Monday or Tuesday forms the high or the low of the week. If you're bearish, the high of the or low of the week will form either on Monday or Tuesday. If you're bullish, the low of the week will form either on Monday or Tuesday, right? So it says that since we have that fact based off of statistics, I mean, you can go through your chart, study at least maybe the past 6 months of data, and look at periods when the markets were one-sided, and see the day of the week, the high of the week formed, or the low of the week formed in a bullish scenario. So the next one is consolidation, two-sided delivery, indecisive weekly profile. Okay, altogether they are basically two-sided delivery. It means for the first one, consolidation. Well, consolidation could be small range, very small range. I mean, it's not expansive, very small range, and say prices were just stuck in between throughout that trading week. And consolidation could be influenced by a number of things. Now, I think it was last 2 weeks, I went on my Twitter account and I was talking about how it's difficult to churn out a trading day the way each days have been structured, because Christmas was last week, right? Wednesday, and a day before Christmas wasn't ideal to trade. That's Tuesday. Now, Wednesday is Christmas, bank holiday. Okay, your bosses are not around. When I mean your bosses, I'm talking about the markets, bank holiday. On Thursday, also bank holiday. And do you want to go into the market on Friday to trade? That makes no sense. Same thing with today being a bank holiday. And I think, tomorrow isn't a bank holiday, right? So when I made that tweet, right, I was making references to how each day is on the economic calendar same low probability, okay, and you can see how last week's range, how it was indecisive. Okay, I don't need to trade the last week's range to determine I think the market is in consolidation. I just had to look at the economic calendar and see how when I saw the bank holiday and whatnot, I just already could determine that there's going to be less liquidity in the market, less volatility, and the market is likely to be in a small range. And it's indecisive. What I mean by indecisive, you are neither trading above a previous week's high or below a previous week's high. You're staying in a small range inside the previous weekly range. That's what an indecisive weekly profile means to me. And truth is, I have a model. Whenever I find an indecisive week, I know how to trade weeks that follow. That's the reason why the price action this week was so solid. Honestly, not gonna lie to you. free of charge, so solid. Now, a two-sided delivery would be something where, probably in the early portion of the week, the market is trading in a particular direction. Maybe from Monday to Tuesday, we're seeing the market rally, and Wednesday and Thursday we have the market decline, and Friday the market is reversing. Okay, that's a two-sided delivery. Now, those kind of price action only happens most of the time when probably the market is close to a higher time frame target. Okay, and the first thing they did is probably retrace into the range, hit target, and reversing, setting up price action for probably like a continuation or stuff like that on the weekly time frame. Okay, so there are so many elements that you need to study before you can determine if a particular week will be in consolidation or indecisive, or ultimately markets are two-sided. And there's been presentations I've had in the past in my commentary where I would say this particular week is two-sided. It's not going to be a one-sided delivery. Okay, we're going to experience both sides of the weekly range, or both sides of the marketplace in this particular weekly range. And the brief explanation I did would, if you can visualize it or not, would probably help you understand what I'm trying to say. And the last one is a seek and destroy profile. Now, the thing about seek and destroy, if you don't know, seek and destroy is the market is running above the previous week's high, running below the previous week's low. Maybe, for example, they ran through previous week's high, and you probably think the market is bullish. The market returns back into the range and runs the previous weekly low, and by the end of that week's trading, you have a small bodied candle settling inside the previous weekly range. So what you're seeing is market took out both sides of the previous range, and that's what the seek and destroy profile is. It rarely happens, but when it happens, it's very, very ruthless. For example, if you look at the dollar index on the daily time frame of the day before yesterday's trading, that's Monday's trading, you see how they ran through previous day's low, ran through previous day's high, and settled inside the previous day's range. That's a seek and destroy profile. But having described all of this profile, one thing for sure is that I cannot predict what a seek and destroy profile looks like. It's either I experience it while on chart and take a loss, or probably I'm avoiding a certain trading day and it happens. I basically cannot, predict a seek and destroy profile. Now, for the integrity of this presentation, we are only going to settle with one-sided delivery, because that's how we are going to amplify this model. We are going to build our model around the trending weekly profile, and that makes sense to someone who thinks. I think if in periods when the market trends, I think I'd rather build my edge around periods like that. When I get in, the market won't stay as long in my entry and remain one-sided for a while. I think that it's around that kind of environment or scenario I'd prefer to build my edge. So the weekly range, I know every one of us is familiar with this candle. This is a bull candle and this is a bear candle. Open, low, high, close. Open, low, high, and close. Now, what are the essentials to sound logic? I mean, because we are hitting the technical perspective of trading the weekly range, and not just that, this is periods when we want to really talk about how we can really determine what the weekly range is going to be like, what the weekly profile is going to be like. Okay, now that being said, the first one is the higher time frame institutional order flow. And whenever we talk about the higher time frame institutional order flow, I don't really understand, or I don't know how you perceive what the order flow is. When we're talking about order flow, in my opinion, if I want to say it in a very basic a very basic sense, I would say um, order flow is just basically where the large speculators, how they are interpreting economic data. Okay, that's order flow for me, because there are so many economic indicators for these things, for example, like the interest rate differentials and stuff like that. And that reminds me, someone texted me um, a while ago, I think 2 days back, and he asked me that how will I do, or how do I do my analysis for the year? What tools am I using? He specifically talked about the interest rate differentials, the macros, and all of that. And my reply was this. I told him that I have the interest rate differential as a mental asset. I know how to use differences in interest rates between two currencies to determine what the underlying order flow can be like. Because if we compare two currencies, for example, and we have a currency between the pair that has a higher interest rate compared to the next, it only makes sense that institutional money would go into the one with the higher interest rate. For example, if say the euro has interest rates of 5% and dollar has interest rates of 0.25%, okay, and I'm an investor in the United States, what am I going to do? It means I'll take my money off US dollar and put it on euro, because over time I'm going to earn more in euro. Do you understand? So money is going to move from dollar and go to euro. So that's how you can use interest rate differentials to determine what institutional players are going to do, or how they are going to be speculating in a currency pair. Now, anyways, what I just said is quantitative analysis. I already started teaching. Now, to define the higher time frame order flow, there are about two techniques in technical analysis that you want to consider. The first one is quantitative analysis, and the second one is qualitative analysis. Now, quantitative analysis is you are looking to data to affirm what the markets are going to do. And I listed about three macroeconomic indicators here. For example, I think two macroeconomic indicators: the bond market, which obviously conversely mean interest rates and yield, and the open interest. And there is one very special indicator to me, is the COT report, specifically the agent program. Now, why the COT report is special to me is because generally traders know about what the COT report is, talking about the commercials, the large spec, and all of that. And the thing is, if I can look at the COT report, it means obviously I'm looking at their interpretation of the interest rate market. Basically, that's what it means. And that's what I told the person who texted me and said, how do I do my analysis for the year? I said, I just stick with the COT report. And me sticking to the COT report is me, looking at their practical evaluation of, all of those macroeconomic indicators. I don't need to make those decisions for myself, because even if I look at the interest rate market, the market at that point in time may not be reflecting, data from the bond market or interest rate, but COT directly helps me interpret helps me look at the actions of, these commercials and large speculators, etc. Okay, so that's why I always favor the COT report. So the next one is qualitative analysis, or what we know as technical analysis. And there are different branches or different models we can use to qualify the higher time frame order flow. Now, back in 2020, when I started learning how to trade in line with the higher time frame buys, and that's one of the things most traders struggle with, because it took me more than 2 years, I think 3 years, to finally have a sound grip of what the high time from order flow is. I always knew what the high time from order flow is, but I could not trade in line with the high time from order flow because I had so many flaws in managing my own expectations, right? So one of the basic ways to determine the high time order flow technically, if you want to look at technical analysis, is by looking at the higher time frame market structure. Okay, now for the past 3 years, I wouldn't call that market structure because Euro USD, or for 2 years now, Euro USD and dollar index has been in a range, basically consolidation. We only just left the consolidation this year, or the last 3 months of last year, right? We just left consolidation, so that's not market structure. But this is the fun fact. The fun fact is, even in consolidation, all of those price action, all of the price, if there is an underlying high time from order flow, the way the consolidations will be structured and the way prices will be moving from range to range, if you can determine what it is like. And one of the tools I use to determine consolidation or interpret consolidating market is through liquidity runs. I'll be looking at areas that has been mitigated and areas that are high res. I think I really touched a little bit of that lesson in one of my commentaries. Probably this year I would run a new teaching to amplify on liquidity runs. Okay, so like I was saying that all of the consolidation, the way market structure will be structured, that was very funny. The way market structure would be in a consolidation could lead you to where the breakout is. Okay, because if there's an underlying order flow in the market, say for example we are trading below an old low and the market is bullish. So when markets are in consolidation, you might not need to look at it from the monthly time frame perspective. You can just look for data that can be easy for you to interpret. Maybe you look at the 1 hour time frame, the 15 minutes chart. Okay, study how prices are moving between the range. Okay, it can tell you that it's going to lead here. Okay, so that's why even when you look at markets consolidating, okay, how each candlestick form is absolutely not random, right? It's absolutely not random at all. Okay, so each the movement between the highs and the extremes of the ranges, the high time order flow would always determine where prices is going to break out through. Okay, so we already talked about quantitative analysis and qualitative analysis, which is basic technical analysis. You can use your chart patterns and all of that, but we understand that those things don't define order flow, right? If you want to look at the markets through the lens of liquidity and imbalance, I think you do a better job in technical analysis than just looking at it through chart patterns and whatnot. So the next one is key levels and reference point. Key levels like your support resistance, PD arrays, because I trade the ICT concept, which is not even a new thing, right? PD arrays like your mitigation blocks, old highs, old lows, rejection blocks, and all of these reference points. Okay, that's how you can define sound logic when you want to define the weekly range. So these are essential tools to sound logic. Okay, first off, you must always have the high time frame institutional order flow at the back of your mind. Okay, that guides how you manage your expectations, really. And the next one is you want to be very, very good at using key levels and reference points. Now, candlesticks. Now we're going back to the open, high, low, and close of candlesticks. And not just about the open, high, low, and close of candlesticks. Now, this is candlesticks in reference to price ranges. Okay, so before you can determine the weekly range, you want to look at candlesticks and you want to know that is this particular candle, is it in premium of the range I'm trading into? Is it a discount? Is it equilibrium? Where is this candle with respect to a key level? Where is this candle at with respect to the previous candle? How does the previous candle tell a story of this particular candlestick. I mean, if you watch me do analysis, okay, if you watch my analysis, you'd see how I talk about each candlesticks, always having like a very normal conversation about candlesticks and whatnot, right? Because it's not really about my order blocks, it's not really about my fair value gaps, it's about the narrative. And imagine someone talking about narrative and there's no conversation about narrative. You're just saying the buy is going to start when somebody tells you that market is going to buy when it gets to a particular order block, and the person is talking about narrative in the lower time frame. I think that's a telltale sign that they don't know what they're doing, because I can't look at the 1 hour time frame and believe market structure there, because the 1 hour time frame could get to a premium and the market could be very, very bearish, or 1 hour time frame could be running a short term high and the market could be bearish on the high time frame. Just any of those things. So I look at the high time frame first and use it to interpret the lower time frame market structure. I don't go to the lower time frame and begin talking about what the high time frame order flow is. There is no sense to it. That's why I can always confidently talk about charts every single week and not having to worry at all, because I know my faith is in the high time frame, and to a large extent I'm well trained in using the key levels, reference points, studying the open, high, low and close of candles. And before we end, I think after this slide I'm going to run through my commentary. I actually I had them packed. I had to do some cutting, joining all of those videos together. It's going to play, and it's going to play for about 10 minutes. And I want you to spend that 10 minutes of your time, or those 10 minutes of your time, listening exactly to the things I was saying, right? And see how they relate to essentials to sound logic, how I'm interpreting the market. But of course, they are a cut from a larger portion. So if you want to get the full import of the things I said or the things I was saying, I would suggest you go back to the commentary and watch. Now, those commentaries, like I said, they are real tutorial videos. Leave the fact that we're talking about analysis and stuff. See it from the lens of a mentorship, okay? I mean, how else would you want a mentorship than someone using the tools they taught you to interpret the market? That's just it. That's mentorship. So I'm going to play the recording. It's going to last for about 10 minutes max, and those 10 minutes is going to blend the high time from order flow, key levels and candlesticks. But before then, there is also a very important factor to essentials to sound logic. Recall when we started, we were talking about the architecture of the weekly range. We're talking about the open, high, low and close. Okay, now how does all of this influence the weekly range? We already made mention of the high time from order flow. We talked about key levels and reference points, and we talked about candlesticks. So it means if you are going to define the weekly range, it means you're probably going to have a key level, maybe a fair value gap or something you expect the markets to go to first, probably in that kind of scenario. Because like I said something. I said if we're bullish, the weekly candle opens, trades lower a bit. So it means there would be instances more often than not where the market is going to, in a bullish scenario, say in a bullish scenario like this, when the market's open here, it trades lower a bit. So it means more often than not, we are going to be seeing this kind of price action. Okay? Now, what if the market opens and you probably had some expectation that the market was going to trade lower, and you open and started running? How do you manage that expectation? And that's where time comes in. Okay? Managing your expectation as the weekly range unfolds. Because now you have data backing that the weekly low or high forms between Monday and Tuesday on trending weeks. Okay, it means you now have the element of time to determine if the markets are likely to trade lower into that reference point you outlined prior or not. Okay. Now, mind you, as we go deeper in this model, I'm going to amplify on questions that you may be thinking already about time. So the video is going to play in a minute. Okay, recall this swing point here is associated with this fair value gap here. Okay, now you can see how to anticipate it obviously, because if order flow is bullish and you have a level that's high risk, why is it high risk? It flipped this fair value gap here. This swing point here was associated with this fair value gap. So if prices run through this level primarily is supposed to hold for support, meaning it's okay for prices to return into the range of this candle, but it's not okay for prices to run this low. But when that happens into a high time frame PD array, you can expect it to be totally super. Okay, so basically prices did that and closed above this fair value gap. So we have an outright bullish price action on the weekly time frame. You can disregard the week because it's only respecting a much more premium gap. So you can see how it's going from one premium level to the next. This one had to close this gap, then this traded into this fair value gap, had reaction, returned back into the range. This traded into sell side, okay, high risk, story soup, returned back, continued bullish, met another resistance here, rejected. Now it's settled above this fair value gap, and that's the major detail I want you to look at. Okay, so now what we're having this week now is potential bullishness on the XY, and that's what I want to focus on: bullishness, bullishness on the XY, and it's how I'm going to interpret it on the daily time frame. I think that really, that would really matter. Okay, so on the daily chart, we have the breaker here. You can see this up candle here prior to the run below sell side here. Okay, that's the breaker. Although we have some tiny bit this inefficiency here because the market essentially opened on dollar index. That was on the election 9th, US election 9th. I think afternoon 9th. It was midnight here anyways. So we have this gap, and prices never return here. They don't always have to return here, at least on the near term. Okay, and looking at how Friday closed, okay, Friday still closed above the weekly gap, so we're currently above support here and support here. So when I was thinking, I was wondering what the markets are likely to do, in the sense that are we likely to see continuation, and are we going to see a return back into the range? If we're likely to see prices return back into the range, how is price action going to set up on the daily time frame that could validate that we're returning back into the range? And if we're returning back into the range, what key levels am I supposed to be watching out for? Okay, and on the weekly time frame, there was just this weekly fair value gap, but look at it. Prices is closing here. There's a weekly fair value gap here. How do I validate prices trading into the weekly fair value gap? Okay, and what I just outlined now is my thought process. Okay, and that's how you're going to think. Okay, if prices are going to trade here, that means the markets are going to look a certain way on the daily chart, and that would validate that the markets will trade into this level, so that when you have your validation on the daily time frame, you can easily frame a setup on, say, the 4-hour chart. Okay, and then if you're holding your trades, you're holding for a near-term price objective, which would be
the open of the weekly fair value gap. And that's how you want to be thinking. Okay, price action has to validate your direction on your target, and we are seeing the markets respect this weekly fair value gap. And what do I mean by respect? Okay, we ran through the previous week's low and completely closed this weekly fair value gap, and we've now closed inside the body of last week's or the previous week's candle or this week's candle. And this kind of price action just indicates that the market is still trying to walk inside the range of this candle. That's what it means. Okay, because we are at a key level, the weekly time frame, the high time frame order flow is bullish on dollar. Okay, dollar index is bullish. I think we've said that a couple times, and we traded into the previous weekly low. Okay, for context. Okay, this is a previous weekly low. We are in a bull market on DXY. I mean, said that a couple of times already, and we're seeing the market run into the previous weekly low, into this fair value gap, and stay inside the range of this week's. So it only means for me, looking at the chart here, is that I want to see prices return into the previous week's high first. Okay, I want to see prices returning to the previous week's high, and if we stay on a closing basis above the previous week's weekly high, then ultimately I think we're having like a bullish swing here, and then we can now aim for the previous monthly high and subsequently the close here. Now, one of the telltale sign here, or one of the things I'm anticipating here, is that we are potentially going to be one-sided for a bit, and one-sided price action really gives you the opportunity to hold trades for the short term or the long term. It depends on how you want to put it. Okay, and if you can get in this week, and with the expectation that prices trade into the previous week's high, and I think it will be okay to hold on to some trades, because it could potentially mean that they can reach for this candle and close, like I said, above this down candle would make this the bullish order block. Basically, what we want to be discussing here is pretty straightforward, because we already talked about the possibility that when the markets begin to qualify our bias, we're likely to see a swing to short-term play here. Okay. Sorry, my voice, I just woke up. We have a swing low here, and when we have a swing low form here, okay, what we want to see is for this candle to draw into the previous week's high. And it's not about being really short-sighted in this case, because like I said, the high time order flow is bullish, and we traded into buy side liquidity here, return back into internal range, this fair value gap here, and the market is making a return into last week's range. So we are likely to find support off of last week's range and attack buy side here, more buy side here, and into the previous monthly high. So on the weekly time frame, the only PD array which I see here is the previous week's high, and it could serve as a reference point for an immediate rebalance. Okay, what's an immediate rebalance? Okay, the market is essentially returning into a previous weekly high, not leaving a space of an inefficiency here. Okay, so when the market returns into the previous week's high, we want to see a quick and sharp response off of this level here. Okay, so on the weekly time frame, this is the only PD array I see here, which is the previous week's high is the only discount array here. Okay, and mind you, the market is at this weekly bearish order block, so we could potentially find resistance of off of here, so the market can enter into the previous week's range from this low here to this high into this high here, okay, and then we can find support.
So having watched that, I think that was that was probably a lot, because when you go through the video, you need to go to your charts too and see how this market played out. Okay, now I said prior that to get the full grasp of the video you just watched or whatever you just saw, to get the full import of it, you need to go to the chart, and see how the markets played out, and see why I said things I said. Now, in defining the weekly bias, like I said, I already outlined tools you can use to define the weekly bias, and you already saw how I utilize these tools to define the weekly bias. Now, how can you define the weekly bias? If you're somebody new and you wanted a guideline to how I would define my weekly bias, what is always on my head, if I'm very conversant with PD arrays, I know the high time from order flow, okay, and to a large extent I'm familiar with the weekly range, the architecture of the weekly range, and how it supposedly influence, how it is supposedly influenced from prior candles. Now, there is just one rule of thumb. For example, when you're looking at a weekly chart and you're on a bull market, for example, whenever the weekly candle closes, okay, this, say in a bullish scenario, markets open here, closes here. Whenever the market closes above the previous week's candle, if objective has not been met, this is a very strong bullish indicator that the next week is going to be bullish. That's as simple as that. That's about knowing how candlesticks and reference points influence your decision. Okay, so defining weekly bias and managing your expectations. First off, what I always do, like you notice from the short recording, is that I always anticipate the most probable direction of the weekly range expansion. That's what I do, and that's what I just said. I look at the market and reaffirm what the high time from order flow is, reaffirm where the candlesticks, the open, high, low, close are, which reference to the dealing range I'm currently trading into. Are we at premium? Are we at discount? Are we at an opposing level? All of these elements, that's how I used to define the most probable direction of the weekly range expansion. Now, your job is to define the most probable direction in a single week. Okay? So for someone who is starting and who does not have a sense of, longer term bias, okay, your job is to predict only where the weekly candle is likely to expand to. That's all. And you do that by defining the drawn liquidity. What's the drawn liquidity? Drawn liquidity could be in form of, internal range liquidity, like the order blocks, imbalances, rejection blocks, because it's still internal range, and external range liquidity in form of old highs and lows. Okay. Look at where prices are. Look at their dealing ranges. Is there some inefficiency that they are likely to reach? Okay. Looking at the same range, as market hit any opposing PD array that could resist price on the near term, or is there no resistance because market has already respected the resistance and they are showing sponsorship to want to reach for that target? These are very crucial questions you want to be asking yourself if you're trying to determine or anticipate the most probable direction of the weekly range expansion. The thing is, you can't be so bullish such that you don't know that even in a bull market, markets would make retracement. That's actually, you are not managing your own expectations well. Okay? You can't be so bearish such a way that you are ignorant to the fact that markets are already in discount. And if markets are in discount, they are very susceptible, or market environment could be easily susceptible to what? Two-sided delivery. Okay? And that's why I was saying, for the integrity of this lesson, we want to stick to, the one-sided delivery, or a trending weekly profile. Sorry, do you get? Because, and those are where you want to get your low resistance liquidity runs, because high resistance is just basically market struggling to deliver prices to a particular direction. Probably markets are bullish, but at every point in time there are lots of resistance levels, and you don't expect that kind of market to be two-sided, to be one-sided, because when it hits resistance, it's likely going to return into the range. Not just return into the range, run a significant liquidity pool. And if you are blind to this fact, you'll just easily be caught offside. Or just like somebody who will just place a buy limit on an order block and says, okay, when the markets get there, I'm bullish. How do you know that market has not hit a level of resistance, and that makes your entry low probability? And that's why my trading model, my day trading model, is hinged on run on stops. Okay. Anyways, determine and incorporate key levels. I think I already made mention of key levels, how key levels influence your decision. And here I'm saying incorporate key levels from the weekly, the daily, the 4-hour time frame. I mean, you watch from the lesson I just played, you'd see that I was talking about, previous weekly high as key level. Sometimes I do that. I just pin out the previous weekly high and explain why the previous weekly high is going to serve as level of support or resistance. And sometimes I look at the weekly time frame, and probably the weekly ranges are very extended, and I go to the daily time frame and pick out a key level. So that's how you determine key level. After you anticipate the most probable direction, you need to determine key levels. And what would these key levels do? You are looking for key levels supporting your analysis and price delivery, as well as levels opposing price delivery. Okay? So while you are looking for levels to support price delivery, you also want to be looking at levels that when price gets to them, you're gonna have some level of maybe a short-term resistance, or depends on where we are into the dealing range we are currently trading into. If we are at discount, we could have and market hit an opposing key level. You can see a short-term displacement against your intended bias. But if we are premium, or equilibrium, you can see market run for major stops before a continuation in the direction of the high time from order flow. Now, you're going to allow for time to validate your expectations and price. Okay? Then you wait for sponsorship in the direction of the weekly bias or order flow, and execute under a sound risk management strategy. Now, what I'm saying here is my last commentary on my YouTube, that was FOMC, right? And when I was talking about Euro USD, for example, I was talking about how Euro is bearish and how we have a daily bearish order block. And I didn't stop there. Price action wasn't clean, so it took a whole lot for me to spot, details. And I looked at, some consolidation of our time frame. And in that consolidation, I said we are anticipating the midpoint of that consolidation. Okay, that's why I said you can check my YouTube channel for it at Settle Black. And the last commentary that I dropped there, I was talking about the midpoint of the trendline phantom. Now, what's the midpoint? It means if markets can trade into the midpoint, I have a bias already, which is I've anticipated the most probable direction, which is bearish, into the previous week's low, and I've determined the key level, which is the daily bearish breaker. But that's not all. I wanted to give more details to it because there was more extra details on price action. That's why I went to the 4-hour time frame and determined the midpoint. Now, if you allow for time to validate, because you notice that on that day, on Monday, market took out Friday's high, and the midpoint of the trendline phantom was a Thursday's high, the prior Thursday's high. That's 3 weeks ago, prior Thursday's high, and market sold for a bit. and eventually ran up until Tuesday. Okay, so it means even though markets weren't meeting expectation on Monday, you still have Tuesday to determine if markets will hit the midpoint of the trendline phantom or not. Okay, and if by Tuesday New York market isn't validating that, of course you can now trade with price action that was presenting on the chart by Wednesday, and Wednesday happened to be the FOMC day. Okay, but now those kind of scenarios is very, very dicey, because if based off of data you outline key levels in market, how market is likely to trade, the markets are likely to respond because price delivery follows some set of rules. And we're talking about algorithmic price delivery and the way the markets deliver prices, and that's why the ICT method is very, very superior, because we're talking about how the algorithm deliver prices on the chart, right? And if they follow a certain set of rules and you're very vast in those rules and you know how this thing works, more often than not prices will respond. And that's why we've been very, very precise in our commentary, because I'm simply following the rules, we're managing my expectations, blending key levels and all of that with a sense of the high time from institutional order flow. Do you understand? It means a day like that, the market didn't validate my key level on Monday, Tuesday, they could literally use FOMC to run up there. And recall, FOMC is a two-stage event, meaning at 7 o'clock instant time, they could run up to the midpoint after building up, liquidity from Monday to Wednesday, New York, and now utilize the 7:30 portion of the FOMC release to now displace in the direction of high time from buyers. That's why if you want to trade, okay, market has to validate your analysis, and that's why lesson 1 remains very, very important. What is the draw on liquidity? Okay, and that's why I spend time talking about it every single week, because once that is sorted, the rest will follow. So now, after you've anticipated the most probable direction of the weekly range expansion by defining the draw on liquidity, you determine the key level, you determine and incorporate key levels, of course, and you allow for time to validate your expectation. You know about how day of the week influence the weekly range, how Monday to Tuesday and all of that, and after that you wait for sponsorship. Once they've hit your key level, you want to see prices trade in the direction of your weekly bias. That is sponsorship, and then you can now execute under sound risk management strategy. Now, still in trading the weekly range, well, this is an add-on. Okay, if you've stayed this long in this presentation, this is an add-on. Once a daily range has been fulfilled in the direction of the weekly bias, okay, the algo seeks a near-term internal range liquidity, like an area of imbalance, to set the range for a new day and repricing continuation of the weekly range. Now, usually, what this is hinting at is just hinting at, because I've been talking about trading the weekly range. I talked about how you can anticipate when you define your bias, the draw on liquidity, and market has, met your expectation to set the low. I said something. I was talking about how when sponsorship has been shown, right, you're going to take your trade. Okay, probably add the retracement, of course. And when market is expanding, now market expanding, in this case, that's once a daily range has been fulfilled in the direction of weekly bias. This is weekly candle, and it constitutes 5 daily candlesticks. Probably the market hit this level here on a Tuesday in London session, expanded and created some sort of maybe a 4 bullish order block and stuff. Okay, and you execute by the close of Tuesday's trading on the daily candlestick, on the daily chart, you're seeing a clear bullish daily candle. So market has fulfilled your expectation to make the low of the week, and market has traded in line with the higher time frame bias. How is subsequent days going to trade until the market hits its near-term target or its target? That's what this is talking about. I'm talking about how once the daily range has been fulfilled in the direction of weekly bias, it could happen on a Tuesday, it could happen on Wednesday. Now, for the next day, the algo seeks a near-term internal range. So it's always funny when in expansive, in one-sided weeks like this, okay, or trending weeks like this, someone is talking about I'm trying to focus on this lesson. Like I said, I'm being hit with lots of thoughts. There's lots of information I need to say here. I'm trying to put as much information here as possible because I have so much written down and I really don't even have time to read before I can speak. So what I'm trying to say is that in subsequent days, it allows for even if you are going to day trade, your expectation should be that the markets are going to seek for near-term internal range liquidity. Okay, you're not expecting markets will not. The weekly bias cannot be determined. Markets will not show sponsorship in line with the weekly bias with a very large range. Okay, with full body closure, and you expect the market to trade maybe 90% of the prior day. That's not the weekly range we are talking about. We're talking about one-sided delivery where the market is just one-sided major times of the week. And this only makes sense because if you look at the daily time frame, the low of each day is just very little. So how does that happen? So it means you're not having the proper expectations for you to engage in continuation of the weekly range. And how can you have that proper expectation? Because now we're still talking about the weekly range and we're talking about how you can manage your expectation. So why this is very important, because sometimes when the market hits those key levels and it has shown sponsorship, for some reason you may just miss the trade, or probably you got in the trade and you got out of the trade because you were not sure, you couldn't trust yourself enough. This is going to address how you can engage for a continuation. That's what this is talking about. It means once the weekly low has been fulfilled and the daily range has validated your bias, you're only looking for near-term internal range levels, an area of imbalance. The markets will trade into there. And these are periods when markets runs overnight because they trade into a near-term internal range, set the higher or low of the day, and expand in the direction of the weekly bias. Do you understand? So that's what this portion of the model is teaching you, that you can still engage so long the weekly objective has not been met. Okay, because that's still a very important factor. That's what I was talking about. Not just identifying and incorporating key levels. You want to look at key levels that support your analysis and key levels opposing to price delivery. Now, when an opposing weekly premium or discount level is reached, collapse at least 70% of the position. Okay, that's very important because, like I said, this model is not going to address if you are as good as defining, if markets are premium, how premium are this, how prices at premium, equilibrium, or discount affects price delivery. This is not going to address that. This is a model that you can utilize without having, without being, without being grounded or trained in defining long-term bias. Okay, so once you can define the weekly range and you can define your price target, once price gets there, you collapse 70% of the position. And why you're collapsing 70% of the position is because even with that, the market could go farther than we think. So it always makes sense if we're leaving something on in the market. Okay, in scenarios where we're bullish and prices are relatively at a discount with respect to the range we are trading into, leaving something on makes sense because you're likely assuming a position that could be held for like a swing trade or maybe a position trade, but you're just not seeing it because you are not seeing the bigger picture. So if you consistently always leave 30% of your position on, most of them will probably get stopped out when you start using this model. And that's the truth. But as you progress, you begin to understand how dealing ranges, the higher time from order flow, is going to influence how you manage your expectations and you manage your trades. Now, the probability of this model increases in trending weekly ranges. So, periods when these are likely to pan out would be periods when, we are very one-sided in the market. And that's why we have to still give credence to the higher time from institutional order flow, because when you're looking at the market from the perspective of macro data, right, you can see 2 to 3 months of one-sided price delivery just by looking at data. Okay, and that's what Michael would always describe as the quarterly shifting the market, and all of that. But like I said, to preserve the integrity of this presentation, I can't teach everything, and we just have to stay with the weekly range. Now, you rinse and repeat. Now, while we're still on the weekly range and managing your own expectations, because everyone could have different expectations watching this this presentation. The first one is this lesson doesn't cover day trading models. Now, this lesson isn't teaching you to trade the weekly high or low. Okay, that's not what this is teaching. But instead, it's teaching you to trade the weekly range expansion. Like you're trading the bulk of the weekly range expansion to what? To an opposing weekly PD array. Again, the probability of this model increases in trending weekly ranges. Now, framing target and price objective. I think this is going to be a very quick one. Okay, so if you're framing targets, like if you watched the clip that played for a bit, you see in some instances I was talking about price target and how I was nimble with price target. Not just that, there were periods when I would want to exaggerate, I want to push the boundary, I want to push my boundary. Basically, if you're with me, I always talk about how the previous week's high, previous week's low, classic, and we'll talk about it here. But there are periods when, recognizing the high time from order flow and understanding that, the markets are primed and set up for a longer term continuation, right? You want to increase your expectations, because now, if we're in a scenario where the market is bullish and has made a retracement and has settled at a key level and is willing to continue, your expectation will be more than just the previous week's high. You want to look at the high of the range, the retracement range, and etc. So the first one is the equilibrium price point of the previous dealing range prices are currently trading into is ideal for longer term target. Now, in this scenario, say you have some high low on the weekly time frame in terms of price range, and we are currently trading into that weekly range. Okay, you want to determine the equilibrium price point, and if you're trading off of a discount, you want to note that, okay, because just above equilibrium is premium market. So once you trade into equilibrium, you want to visualize it as your longer term target. Now, to do this, I want you to go to your chart. I want you to look at every single dealing range on the high time frame. We're talking about the weekly time frame. Okay, you know what dealing range from a swing high to a swing low, and most times this swing high must have run a previous liquidity. That's how you determine a dealing range. Okay, dealing range are usually high resistance and market mitigated to make a retracement and stuff like that. So a dealing range is a high, a swing high, a major swing high or swing low that's run liquidity. That's how you determine your dealing range. And in a scenario where the high time from order flow is bullish, definitely we're bullish with respect to a previous dealing range. Do you understand? It means market is probably retracing inside a previous dealing range. Bullish could mean we're going to run the high of the dealing range, but while we're still trading inside the dealing range, the equilibrium price point is very crucial, okay, and is ideal for longer term targets. So if you want to frame price targets for longer term price objectives, Now, aiming for the prior weekly high or low is classic. I mean, is efficient for most weekly profiles, whether consolidation, seek and destroy, which is not advisable, or trending. This is a classic. You're trying to aim for the previous week's high or low. Now, the other unpopular techniques for framing price objectives, such as utilizing opposing higher time frame PDA rates for targets, which I do very, very often in my commentaries. Okay, and sometimes there was this particular week I was like, okay, we're bullish, but we have a swing high, and then markets would most likely trade into this range, but respect the weekly bearish order block. I even posted on my Twitter account. Okay, while still validating the fact that that current weekly candle could likely trade into the previous week's low, I was talking about that. So early portion of the week, you can be bullish on dollar because dollar was the asset I was discussing then. You can be bullish, but now your price objective would be the open of the weekly OB. That's how to frame objectives, okay? And you can't just simply learn it at a go. That's why these commentaries will help build how you manage your expectations. Now, you can also use the Fibonacci extension tool, the negative standard deviation. Most times, I always use it when prices are especially, I didn't include at all-time highs, but that doesn't matter. Now, trade management and psychology. Primarily, this is where we were supposed to have bulk of our discussion here, and yeah. So, having learned tools, rudiment, and see me perform, let's talk about the real world, really. Now, what if? Because this is a question, and this is something you're going to experience lots and lots of times, and that's why I had to talk about them steadily while we're discussing this whole model. What if there is an ideal and obvious level in the prior range that you expect the markets to trade into first before the bulk delivery in the direction of a weekly bias or draw on liquidity? Okay. Now, but the markets did not trade internally first, or they probably trade internally, but they fail to reach this internal range objective. Now, leave all of these semantics and all of these things. What I'm trying to say is that, say you have an obvious level you expect the markets to trade into first, before markets now expand in the direction of the high time frame bias, and say the market got close to it, or didn't trade there first, and it now started showing some kind of sponsorship in the direction of your bias. What are you going to do in those kind of scenario? Okay, and that's where I was talking about how you incorporate time, and time in the sense of what day of the week. The market opened, okay, your analysis is sound, and you have an expectation for price to run through internal range, and the market just open and begin to displace in the direction of high time frame bias. How do you validate that they are not going to trade there or not? First one is it depends on your analysis. Okay, that's always the first thing. If your analysis aren't solid, you are probably not even looking at markets from the correct perspective in the first place. That's the truth. Okay, I've had people share me their analysis and they have a clear sense of the higher time frame draw on liquidity, but they don't have a clear sense on how the weekly range is going to unfold. Okay, and to manage that expectation, first thing I do is to correct it. After correcting, that's not all. Then we submit to time to validate. Okay, so that's your waiting game. Now, if 80% of the time I'm always right about how the weekly range will form, I mean, for me, not you, for me, if I'm always right 80%, or if I am right, it's not always, if I am right 80% of the time, it means whenever I have my analysis, it only makes sense that I always submit to time to manage my expectations if price action isn't validating my expectation early on in the week. So by Tuesday, I already know that, okay, it's either I'm wrong or I would have to adjust to price action data. Do you understand? So that's how we can manage, because the whole point of this thing is so that you can manage FOMO you know, when you have an expectation, for example, say you're someone who is very sound with your analysis and stuff. If prices are not meeting expectation and they are now trading, and you want to trade the weekly range, you are likely to fall into despair and some level of you don't want to miss out on your setup and stuff like that. And that's how, you probably take a loss, and market still goes back to validate your expectation and all of that. So this is how you want to manage FOMO. You want to manage FOMO. How long have I been speaking? You want to manage FOMO through this. Oh, what's this? So we're gonna pardon the. We're gonna pardon the distraction. I think everyone is really excited about the new year, and I really don't like this. Anyways, I'm not at home. I'm somewhere else. So and I don't know. There's like a mosque very close to this place, so it's kind of like messy. So I've most likely lost my train of thoughts, but I understand that. I think I was able to pass the message a bit. Now we're still discussing the real world because this is the final portion of the commentary. I said commentary, the presentation, talking about psychology, trade management, and stuff. So what if prices continue higher, running higher or lower depending on trend past your defined objective? Like I said prior, always what comes first is, you know, what the high time frame order flow is, right? And when you take a trade, having defined your weekly bias, the markets can always go beyond our expectations, but there are other key factors you want to be looking at, okay? And that's why, I was talking about always leaving a portion on, okay? Because, basically short-term trading is the gateway to swing trading, right? And what it means is that if you can consistently take short-term trades, you're likely to you're likely able to hold trades for longer term, right? And to qualify this, I'm really getting frustrated. That's the truth. I'm really getting frustrated, and it's I don't like this. Alright, so I took a pause on the OBS. You probably not notice, and that's how you can have the risk management come out here. So I'm still talking about what if price continue running higher or lower depending on trend, and that's why we must always validate the current market prices with respect to the dealing range they are trading into and the underlying order flow. That's the key factors. You want to validate the high time from institutional order flow, and you want to validate where prices are with respect to the dealing range they are trading into. For example, now if prices are in discount with respect to their prior dealing ranges, say if you measure from a high to a low, and market is about maybe 23% of the Fibonacci, and higher time from order flow is bullish, okay, we've noted the price range, and now we understand what the higher time from order flow is. It's going to give you a sense of, okay, even if I'm going to collapse any trades, this current position I'm running, okay, or I'm on, is likely to hit for 50%. And now think about where 50% of that range is in terms of pip range. You already see that it can help you manage your trades better. Not just that, okay, not just that, it's also it's also a telltale sign that you're likely on a swing position. And how do you know your swing position? We talked about ways to define the high time from order flow: the macro perspective, okay, which is quantitative analysis, and the qualitative analysis part, which is you drawing the Fibonacci to determine where you are at price range, okay. So to manage that trade, okay, you'd want to leave something on, okay. And that's why I said this is the real world. All right, because you can't go through this lesson and you want to think small. I want to stretch you for a bit. I want to stretch your mind and stretch your abilities to look at prices the same this way. It's this is a model itself. See, you cannot make money if you cannot hold. That's the basic truth. Okay, that's the basic truth. If you want to make a whole lot of money, you have to learn to hold for longer term price objectives. It's always difficult to hold, and that's why you must be able to talk about narrative and build context around your setup so that you can be able to hold your trades for longer term price objective. So now, talking about the risk management portion here, and for me, any amount basically you can afford to lose qualifies for um, risk management. Okay, you could get 100k proprietary trading account, and truth is, you probably did that with your last card. All of those 10% drawdown, you hit it in a flash. Do you know why? Because you can't even bear to see yourself lose the account. So risk management is not hinged on the size of your cap. It's hinged on, can you lose this amount? If you can't lose this amount, you are not under sound risk management, even if you are risking 1% per trade. Now, I was talking about equilibrium and premium and discount and all of that stuff, and I was talking about how equilibrium and premium discount always influence how you manage your trades, your psychology, and and that's why you must always note the equilibrium price points of the previous dealing range you're trading into. Markets are likely to see correction from this equilibrium price point, and this would really help you to manage your positions. I've said that many times. All of those positions you've assumed, and not just that. While we are trading the weekly range, there are lots of consecutive weekly candles that will be forming on the weekly time frame, and some entries, even if they are short-term trades, they are late, which for the fact that they are now very close to premium objectives. So if you note the equilibrium price point, you can easily collapse the later entries 100%. You can leave the much earlier entries because market could see corrections from here, and those corrections can also even present, they could be opportunity presenting, because like I said, order flow is different from the weekly bias. Order flow may be bullish. That doesn't mean we can have a down week or 2 down weeks. Now, those periods when we'll be having down weeks, the drawn liquidity could be internal range, like some fair value gap. That's still drawn liquidity. Do you understand? So, always noting premium and discount levels would really help. Now, there's a general rule of thumb for me is that I can't always be as bullish when markets are in premium, even in the markets when the high time for order flow is bullish. If the high time for order flow is bullish and markets are bullish, when they get to premium, I'm always nimble with my objective. I'm always nimble with how I set price target. I'm always nimble. I'm just like tiptoeing. Okay, low hanging fruit is how I want to aim for objective. And what's low hanging fruit? Previous week's high or previous week's low. I want to be nimble until it gets to a point when price is now setting up to validate, okay, we are likely to make a continuation into our longer term price objective. Then that's when I begin to expand my expectations and stuff like that. That's why I said there's a lot to do with managing your expectations. How do you expect the weekly range to trade? How do you expect markets? How do you frame your target? It's still expectations. So all of these things are hinged on how we can manage our own expectations. So I think this we are talking about the end of this. We're now at the end of this presentation, and I hope you found this one very insightful. Until next time, be safe.